Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. Financial advice as a profession continues to change and adapt, but at the core, it is about helping people. Today, I'm joined by Fraser Jack, who is a retired financial advisor and now founder of the Cyber Collective and host of the XY Advisor podcast. Fraser and I will discuss the value of advice and why we both became advisors, but also how we have adapted to help the many over the few. Fraser also talks about the money mindset for clients and how advisors and coaches need to understand the emotional behaviours that drives a person's habits, motivations and values, as it's not all about the numbers. Well, welcome, Fraser. I'm glad you could come and join us on our podcast.
Thanks for having me, Marc.
Normally my focus is usually on the sandwich generation, as you know, people those in their 50s and 60s. But ever since I've known you, and we've known each other for a long time, you've just been excellent at seeing trends and even influencing trends, especially when it comes to money and how people get advice. So I just thought it'd be great for you to be on the show, give your views on what's happening and where it's going. And if I had to start with one, it's my old chestnut is I find advice is just way too expensive, and it's just basically becoming for the rich. It's not affordable, and we do need to do different ways to make it become more affordable. Let's have your view on that then as a starting point.
Absolutely. So much to unpack with that. Now, just letting your listeners know that I'm nearly at the sandwich generation. I'm 47. My eldest is 18. So I'm almost tapping on the door of the sandwich generation. But I'm getting there. And you're absolutely right. I've loved following trends. I'm really inquisitive about human behaviors and those sorts of things. So I'm always interested in these types of things. Now, when you mention advice affordability, I often, that's always a really interesting one, because sometimes that's always a deep thought in the back of somebody's mind, but it doesn't necessarily always come out, because I find that a lot of people think, can I afford this? Is it going to be something? But then approaching that subject is almost like they have to not fall on their sword, but admit that maybe they can't afford it, or get to a point where they actually have to make an outwardly based conversation around yes or no, I can afford it, or no, I can't afford it. And so it's often something that people sort of feel, but they're not necessarily expressing in the conversation when they're having a talk to advisor. They kind of want to get that information out of the way before they take the leap of faith into going into an advice office or a meeting with a financial advisor and saying, okay, I'm here now. I understand the affordability thing, and I've been through that in my mind, and now I'm actually ready to make a decision. So it's kind of something that I think financial advisors have grappled with over the past, as to how do you get the value of advice conversation out there so that people can appreciate that before they walk in the door. And I guess you and I both know that, financial advice is all around, being in the best interest and leaving the client in a better position. And we have all these phrases that we use internally inside of the profession that talks about, yes, well, of course the client's going to be better off, because that's a legal requirement that we must follow. So surely they would know that. But I think the answer to that is no, most people don't actually think that in the back of their mind, or get that understanding of what affordability is and the concept of the value of financial advice.
And just on that, they don't even actually know what a financial advisor actually does. So, yes, it's an emotional decision. Yes, it's the affordability and thinking about that, but they're not really, when most people see me for the first time, same for yourself, I'm sure, they just we didn't know what to expect.
Yeah, absolutely right. And like you, Marc, I guess I should throw out there that my current status is retired financial advisor, not financial advising anymore. I used to be for many years, but not currently a licensed financial advisor, if we use those terms. But you're absolutely right. The concept of what is financial advice and how's it going to benefit me, and what are all the parts. We have this concept of a financial plan, which is great. But then sometimes advice is not necessarily a plan. It's just a piece of the plan or a piece of the jigsaw puzzle. Sometimes advice is a long, we think of this long document which is provided to clients called a statement of advice, and that's not actually the plan either. The plan is all of the parts around that, or what the clients want to achieve and how they're going to achieve it. So a lot around the strategic work that goes on around financial advice. So yeah, there are a lot of miscommunicated concepts around advice, I think, and it's pretty easy for some of the older professions to go, yeah, we all know what doctors do. We know the word GP and we understand how that works, and we know what specialist advice for doctors are, specialist doctors are. But when it comes to a really new profession like financial services and financial advice, it's difficult because there's just not that generation of information that you learned growing up as a kid as to what financial advice is.
Yeah, and so do you think we, as a profession, and we're going to talk about the different ways advice is given and what the new concepts and way of people are doing it, but do you think as a profession, when we're both financial advisors, and we were there in actually on the associations and helping advisors on this, we're just terrible at communicating what we do, aren't we? Simple as that.
Yeah, it's quite interesting because, the concept of, let's go back, right? So financial advice came out of the concept of there were financial products that hit the market, and the regulators said, we want to make sure that these products are regulated to protect consumers against, overly zealous sales of these particular products. They've got to make sure these products are right for the person before they get access to them. And so the financial advice industry was born. And then when the legislation came into account, there was a whole lot of stuff that went on that your listeners don't need to know about. But a long story short is financial advice became within the legislation and the terms of the law, a product itself. So that the advice was a product and the products were products. And that's where there became all of this, difficulty and expense and compliance around how can consumers get access to the advice. And then we had, like the what we call internally aligned distribution, which was, if you go into a Toyota dealership and you want to buy a new car, they're going to sell you a Toyota, right? That was what you came in for. And most people get that. That's why, or they go into a bank to open a bank account. They're going to open a bank account inside that bank. So that became a thing. Nothing wrong with that, except the way that legislation was that those bank advisors had to compare all the other banks for, product. And so it just became this weird thing where you couldn't just go into your bank and expect to get the bank product without them having to compare all the rest of the market. So there was all these weird anomalies that took place behind the scenes.
Which added to the complexity and added to the cost.
It added to the complexity, it added to the cost. And so because of that, there was a huge cost to advisors to provide financial advice. And we're not talking about, whether that was an accurate representation of the real value to the consumer, or we're just saying there was a big cost. There was a big licensing cost. There was a big compliance cost. There was a big legal cost, oversight. There was a lot of training. Obviously, there's a huge amount of training that advisors do every year, ongoing education, professional development. And so there was all these expenses that added up to, before a consumer even got financial advice, there was $500, $600, $700, $800 per client in the costs for the advisor before they said a word. And so, that's sort of that's what's happened. But thankfully, most financial advice offers way more than that as value at the end of the day, whether it's immediate value or whether it's a value over the long term. And I should make this point too, that I see that there's two types of value. There's the numbers, like we're all numbers people. We love numbers. We like to see, if you did nothing, you'd be on this trajectory and you're going to end up here. If you did something, if they did these recommendations, you're going to end up here. And you can see that as either, a growth in what you were going to get, or you can look at it as, if you didn't do this stuff, you're going to lose that money. There's two ways of looking at that from an emotional point of view, but that's the numbers. But most people or clients of financial advisors, when you talk to them, then it's not the numbers that they're there for. It's I was uncertain and confused, and I didn't know. And now after the process, I'm confident, and I understand everything, and I know exactly where I am and what I'm up to. I know exactly the information. And so from going from confused and not sure to being confident and knowing is sometimes from a client's point of view, the true value of the process, not necessarily just I'm going to make, an extra X amount of dollars between now and when I retire.
And add a third, if I might, just is the accountability. People, if the best tennis player in the world needs a coach still, why don't we need a coach for our own finances? And people say, yep, I've got a plan, I've got a goal, but after 3 months, and we just only have to look at New Year's resolutions, for an example, how most have finished within 3 months. So people need someone to help them stay accountable, that financial gym buddy, so to speak. And so I really do agree. People get value, not just so much in the numbers, but in the actual, they're feeling confident about their situation. They feel like, yep, I'm on target, but then they still need that annual review or ongoing review to make sure that they do, because, life gets in the way.
Yeah. And just inside that accountability piece, there's often, there's often two parties in a client situation. There might some clients are individuals, but there might be, let's say, a lot of clients are couples, and within that couple dynamic themselves, there's kind of more of a CFO person that takes more charge of the money, and then there's the person who's sort of more passive in that couple, and that non-CFO person. It's really around saying that, to giving them the opportunity to come in and be part of the process, to having that accountability, but also that time when you can just go, no, we're just focusing on the numbers here, because that person might not get to have much of a say, or that person might not to ask questions, or doesn't want to ask silly questions at the time. So I think it's just, the accountability is great, and also having that platform and opportunity when you're doing regular reviews to be able to just stay involved in the plan.
Let's just take it, because that's, I think, with the actual advice part and the value, and every advisor has to actually show the value, otherwise you just wouldn't go ahead. But still, it's costly. I think it's costly anyway. And so we want it to be more affordable and to reach a greater, because the numbers are that not more than 20% of Australians get advice, and it's probably even lower now. So there's that other 80% who definitely can do with advice or help, but aren't going to be able to afford it or want to pay that amount of money. So where does things like robo-advice, self-serve fall in that space?
Yeah, there's some really good points to be made in this. And just going quickly back on affordability, technically, if we're numbers people, we go, it's affordable if you're $1 better off, right? Like if you spend $10,000 on something, but the end result means that you're $10,001 better off, then it's a positive, right? So obviously there is a tipping point when it comes to pure numbers that says if you're going to make more than you spend, then that's great. But getting into that conversation around the percentage of the population, it's really interesting. I look at it as a bell curve, and I go, great, there's a bell curve, and any industry, any products, any profession, there's usually around 10% of the population that'll pay up to 10 times the price for a prestigious end of a market. So that's why we have Parada handbags. That's why we have first-class seats on an airline, et cetera, et cetera. So there's often a prestigious end of any particular marketplace. And in financial services, I kind of feel like the paid financial, I've got my own financial advisor piece is almost that prestigious end. And we need to think about that to say, well, okay, we've got that covered, because technically the conversation is anyone can trip over, any industry can trip over the top 10% because they're going to be there already. What we really need to do is say, how do we then help the mass market get access to quality financial advice in a way that they are not feeling like they're having to pay the prestige end of the market. Because there are, if you only got to look at home renovations, and there is a massive DIY market, and there is I'm just going to get a builder to come in and project manage the whole thing, end of the market. And then there'll also be an end of the market, the same with any bell curve, that there's no one's going to do anything. They're not going to ever want to do any renovations, right? So same with financial advice. It's probably 10% of the population that are never going to want to engage. They're not the people listening to this podcast, obviously. So if we think about that middle market in any bell curve, there is obviously different segments of that as well. But how do we then help and educate? And obviously, this podcast, for example, is a great way of that people getting education in a space and in and around a space, and then understanding, and then being able to engage and move into things and be able to make informed decisions of their own. The same as a DIY person likes to go to Bunnings or any other hardware shop. We're not here to advertise one brand over another, but we're talking about the concept of it's a huge part of, people going in and doing a DIY. So when you talk of robo-advice, that's a industry professional term that we all talk about that says access to something that can help you in a very narrow band do a particular thing and be better off in the long run, right? So that's sort of what we're talking about. And so technology is a great way of doing that. When we talk about technology, obviously we got broadcast. The old school technology was books, right? It's about saying here is way that I can get my words out to many people. And obviously, you've got a book, and it's a way of people getting information. You've got a podcast, it's a way of people getting information. So they're all sort of areas around that. How do we help that mass market? And then from that, we're talking about what you're talking about is concepts, general information, different emotional things that people might be thinking and answering questions. You're not providing financial advice on a podcast because you can't, because you don't know that person's individual situation. But with a technology that may be asking a few questions and then can do some decision tree type conversations, and then say to a person, generally speaking, as somebody with these types of things might want to do that, but that doesn't take into account all the other stuff you've got in place and all your estate planning, and it doesn't take into account all the other things that a personal advisor does. So I guess it's really complicated from a point of view of if you get a builder in to do a project on your house, they're going to look at plans. They're going to look at, what's under the ground, what's here, what's there, all the other things, versus a DIY that kind of just wants to fix that one wall, or fix that one thing, or fix one thing at a time. So we're always going to have a DIY end of a financial services market. People are going to go in and go to their bank and get their own term deposit. People are going to go into online and buy their own shares on a share trading account. There is a DIY end of the market. The problem is there's probably not enough education as to how some of those individual products affect other individual products. And we're making the big assumption that they've, like you said before, got an accountability buddy, and we're making another assumption that they know what the outcomes, where they're heading, what their goals and hopes and dreams and aspirations of they're trying to achieve are. Because I heard a saying the other day that talked about the concept of if you're just blindly doing actions with no plan, versus having a plan and then doing the actions towards making the plan happen, then there is the big difference in the outcome.
Yeah. So when you look at, say, the process an advisor has to go through, and they've got to get the data collection, they've got to do the analysis, and then they've got to compare products and all that. You can just see there's definitely, even just in the data collection, there's definitely different IT platforms which are pretty well allow people to do it themselves. Because when I talk about AI or robo advice, I don't actually see it replacing the advisor. I just see it making the advisor more efficient in so many parts of his day-to-day job. Because there's definitely areas, you just think some of the research where you just got to sit down and analyze this, where there must be a button, press, and it will provide all that research and information for you. So we just got to be getting better at that.
Yeah, absolutely. And when I think of, and if this goes back to where advice came from, so it was a process that then became, we have to make sure this advice is a product, and we've got all these rules and regulations, and it's expensive to administer and to have compliance people looking over your shoulder. So the process became very much a compliance process, right? It was about how do we tick all these compliance boxes and make sure that we're doing all the right things by the regulators, so the clients are better off because they're protected by the regulation, right? Instead of like any other industry that comes in this or profession that goes, how do we make sure the clients are great. They're happy. They've got everything. They know what they're doing. They've gone from being confused to being empowered by the information that they've been given, and then make sure from there that all of the compliance legislative requirements are met. So sometimes the process has been, we need to do this series of processes because that's what is legally responsible to do, blah, blah, blah. And now we'll introduce some technology that's going to speed up a really bad process. So instead of taking a client from, we're here to make you happy, we take a client from, we've got a really annoying process and we're going to bring it to you faster. So that's going to make you even more annoyed, or we're going to make you annoyed even quicker. So sometimes they're introducing an efficiency in a process that's already that's in a process that's not great, can bring that to the client faster. But then what we're trying to do is add efficiency with the cost. So we're trying to say this will actually reduce the cost and therefore be better off. Because when I think of the value chain, I love this conversation. The value chain to me is at one end of the chain, you have the shareholders of a small business or a business. And the other end of the chain, you have the clients or the customers or consumers. And all of the bits in between are all parts of the process. And there's this and that and compliance and licensing and regulations and all these other things. All those things cost money, but none of them pay at the end of the day. It's either passed on to one end of the chain or the other end of the chain. So it's either the shareholder of a small business that has to pay for an inefficiency or the clients that have to pay for an inefficiency. Mm. So from that point of view, advisors have always been trying to make things more efficient because one, it comes out of their pocket, or they have to ask their clients to pay for it, which they hate doing.
Mm. So, yeah, I get your point. Yeah, we're trying to be efficient, but for a bad situation. So is one of those bad situations, and it's one of the things about, and it's what's called the know your client rule, whereas, a client, and let's go back to your analogy of you walk into a Toyota, you're wanting a Toyota. You're not expecting that person to, well, before I can actually sell you this Toyota, I've got to compare this Toyota to every other car companies to make sure it's the right one for you. I've walked into a Toyota. I know I want a Toyota, so why don't you sell me? So that's silos. I'm coming to see you as an advisor because I'm about to retire. I just want my retirement. I don't need you to look at my debt, my estate planning, my whatever, my life insurance. I'm coming to you for a very specific reason. I'm going to retire. So will I have enough superannuation, for example, to last my lifetime? There's something very specific that can be very efficient in doing that. But as an advisor, we've got this know your client. Well, yes, we're looking at your super, but really, we really should look at your insurance. Otherwise, I'm not doing my job as per the compliance. That's one of the areas you're talking about.
Yeah, I always relate the process back to that of a doctor or a GP. You walk into a financial advisor and the GP says, tell us about your complaints. What's the triage? They want to know if you've got a gaping wound hanging out straight away, or whether it's it's a general checkup. And then they go into do the tests and they ask you the questions and it's with a doctor it could be they have to force that into a 7-minute process, but other times it's forget about the length of time. It's the understanding, knowing, thinking about how that affects all the other parts of their operating system or their health or whatever it might be, and then diagnosing something, then creating a treatment plan, which may or may not include medication. In our case, we call it financial services products, and then prescribing and allowing the clients or the patients to go and get treated. It's a similar professional process for a financial advisor, right? You've got to come in, we've got to know the client, but that legislation that says that just says you need to know the client, and then the lawyers that look after licensees go, you need to have this, you need to have that, you need to get all these other things. And then we've got other professional obligations thrown in there where, as a doctor, if you see somebody is got other problems, you should refer them to other specialists for that as well, even if they came in for something rather around their arm, but you can tell that they've got something going on with their blood sugar or something. You've got to send them off to, you've got to actually treat the other parts as well. So it's kind of like that in a sense when you engage a financial advisor, that they have that liability and responsibility to make sure that the whole of a client is okay. And that's where it starts with. It's about making sure they're okay first. But then with advice, the advisors are pushed to the limit on, actually, no, you can't just be okay. You've got to be a lot better off. And so, there's a few problems with that as well. I mean, with any new profession or new legislation, there's always years of ironing out these wrinkles. And we do have to remember that advice is a new profession, and there's going to be these for probably generations to come. But there is that scenario of it. Now, how do we then say to somebody, like doctors do something in 7 minutes, just give you something for the thing you walked in for? How does that happen in advice, and how can we bring the cost down? I mean, the difference is, a lot of the times, there's government schemes. Accountants get a legislative requirement every year to go see an accountant, so people have them. Doctors, everybody knows what they're there for, and there is a Medicare type system that supports people in going to see them. But yeah, when it comes to the advice profession, there's not really anything from the government that backs advisors or supports advisors or supports consumers with getting access to lower cost financial advice.
Because one of the things that adds to that cost, if we just, on that analogy of the doctor, is that when that doctor says, okay, I see what your problem is, I'm going to prescribe XYZ drug, you don't sort of say, well, hang on, is that XYZ drug, is that better than the ABC drug? And what comparison and what research? No, you're there, you're trusting the doctor has done the research. That's the particular drug that he feels is best for you, he or she feels best for you. Whereas an advisor, no, we can't be left with, okay, here's your problem, here's a product that will fix that. We've got to go into, well, yes, we've had to compare. All I'm just saying is that extra complexity just adds to the cost. So at the end of the day, advisors have to prove good value. And the one thing I would say, because we're sort of having a go at the complexity, and I don't want anyone to be turned off on this, the good things is, as Fraser, you just said about they have to show you the value. But secondly, it's not like the old days, it's set and forget. No, that advisor basically has to come back to you every year and get you to sign off that you're still happy with the advice. And if it's not, it just switches off. So most people, the worst case is they're going to be paying for a service for 1 year. And there's that. So I know that's safeguard. But if we move to the other side of it, you mentioned DIY a few times, and it's just been a really interesting phenomenon the last 10 years. And it's one of the reasons you left advice. I've only just recently left advice, is that we realize that there are so many other ways to help people on money and finances and coaching and education. And you've definitely been one of the trendsetters on that. Podcasts definitely was one of your big ones. Do you want to tell you why you feel that's, for those DIY, how that's a really helpful scenario for people?
Yeah, absolutely. It's been, you're right. Every single financial advisor I've met and spoken to, hundreds of them over the years, is there for the same reason, as you mentioned, to help people. And people get into these types of professions to help people because they want to help other people be better off in a scenario. And, we can do that. We can do that one-on-one. We can do that one-to-many. And then with the concept of podcasts, we can do it from none to many. It's sort of a marketing thing that we think about. How do we relay a message? If I'm sitting in the room with you, I can tell you, you understand it. I've helped one person. If I can tell, if I can sit in front of a conference or a room in a seminar, I can help many people. If I can create a podcast, then this content can stay what we call evergreen and help whoever downloads it. So it is absolutely about trying to scale the message and feel better about helping more people. And I do a lot of work with financial advisors in that space as well. So to me personally, it feels like I'm helping people who are helping people. So it gives me that sort of that double whammy. So I think it's always the way that when you realize that you can help somebody and that what you're talking about, the financial advice itself, is so beneficial to people that they get so much out of it and it can change and transform their lives forever, that you just want to shout it from the rooftops. But unfortunately, you can't. The hardest time to give financial advice is when you're a financial advisor. It's it's there's plenty of Uber drivers out there that do give plenty of financial advice, unlicensed and unregistered, and so it's or influencers, all those sorts of things. So I think to me, it's around saying somebody who has seen the benefit, understands what the value of advice provides to a consumer, and then goes, as part of my legacy of what I would want to leave left in the world, it's like, how have I helped thousands of people, not just hundreds of people?
Yeah, no, very well said. And one of the reasons that resonated with me when you were helping me set up this podcast and coaching me on this was that you really did say, well, how many times have you actually talked to a client about retirement or their estate planning, and they needed to get a will and say, oh, why do I need to get this? And I said, I've done a podcast. Every one of those reasons has been explained, and I've got an expert on that, an estate planning lawyer per se, to tell you exactly why. Just listen to that for an hour, and that just answers all your questions. And so rather than have to keep repeating it, you've got it there, you said evergreen. Actually, as an advisor or coach, it's actually very beneficial because, okay, I get that. I can sort of see the value even before I've even met you.
Yeah, exactly right. And not only that, when people listen to a podcast, if you get something out of it, then you can share the podcast with your friends. And so, you talk to somebody about their estate plan. It's one person. It's you directly to one person. You do a podcast and all of a sudden, a lot more people hear about that story. But then if they're talking to their friend at a barbecue about their estate plan and the stuff that they've just done, then they can actually send that podcast or the episode to that person as well. So it's a shareable piece of great information that can help many people.
Yeah. Thanks for that. Now, one of probably the last things I would like to talk to you, because you talk about this a lot, is actually if I talk about sort of the holistic plan, it's not just the numbers, as you said before. It's also having that life balance. It's having your worrying about your health, worrying about your next challenge, the mental side of it, the motivation. So when you look at that, the money mindset, I think you've phrased it there. How do you approach that subject with a client, with advisors you talk to?
Yeah, it's one of the biggest parts of the difference between people that are really successful when it comes to financial their finances versus those that aren't, is that their actual mindset, their attitude towards money, and how they think of it and how they treat it. And we all grew up in a household where there was, whether we knew it or not, there was influence being put on us by our parents as to how they valued money and some people come from a scarcity, money is the root of all evil. Other people come from the abundance of, money is the greatest thing. Go and get as much as you can and enjoy life. And so all of these, as human beings, we're a ball of emotions, and a lot of those emotions are set in stone inside of our brains from our childhood. And then when we grow up, we have our own experience, and they either, they either back up what we've learned, or they go or take you in a different direction, or whatever it might be. You might have motivations to not be like that, so you determinedly go and change it. So look, that's the thing about the mindset. Everyone comes at it from a different point of view, and we as human beings make decisions generally using our emotional part of our brain. There's all sorts of studies around this, fast thinking, slow thinking, and all these sorts of things. And I just see it as, we have emotions, we make decisions with emotions, fear, stress, anxiety, all these things that demonstrate as to why we do things. And then there are logical parts to a conversation. And it's very easy for you and I to have a very logical conversation about somebody else's finances, because we can technically see where they'd be better off, and we can come up with a strategy that might be great for them. And that's amazing. But that person has come in with an emotional mindset, and we're giving them a rational plan. So one of the big things that I think that happens with the advice process and the relationship with a financial advisor is that they then understand the emotional behaviors that drive a person's habits, drive a person's, motivations, their values, all those sorts of things that build out what makes that human a human, and the reason that they make decisions and how they make decisions. And so if I said to you, do you want to do this plan that's good financially, you kind of go like, yeah, that's good. And I'm like, okay, so what that means to you is you can feel blah, blah, blah when you're in retirement because you're now able to have, a cooked breakfast twice a week versus living on Weet-Bix, and you're able to, when your friends say, do you want to go out for lunch, you have the dignity to be able to say, yes, I can come for lunch, and that now means something to you emotionally that the numbers didn't. So to me, there's always a logical side to a financial plan. There's a logical side to it that if you do these strategies, you're going to be better off financially. And then there's an emotional side to that. What does that actually mean to that person who's sitting thinking about the numbers and the decisions that they make and how that's going to affect the way that they feel in the future is really, really important. And it's overlooked so often in a process where the regulators go, oh, take it from financially here to financially there. It's always been a relationship business because of that, because of the fact that people can now make emotional decisions based on logic. So it's very easy to make emotional decisions in the now thinking I feel this way right now, so I make a decision now. But then when you sit back and you think about things and you add some technical logic into it, sometimes you come to a different decision. But if you just added that logical process a little bit more and gave it some more time and space, then the money decisions that you make over a long period of time, over your entire life, whether it's buying those shoes today or not buying the shoes today, whether it's splurging or not splurging, whether it's investing and for the long term rather than just keeping the money in a bank or under your mattress. The difference is so great at the other end, but that difference is only financial unless you relate it back to the emotional impact that it actually has on people. So I think that's where that's what I'm really interested in when it comes to behaviors, is to what drives behavior, what drives habits, what drives those sorts of things in people, and then how do they apply their financial life to that so that they'll be, better off in the long run?
Yeah, and I do believe that is the next progression for advisors and even for financial coaches to understand that side of it, and should be part of your CPD. We do 30 hours a year in training. A third of it should be for nearly that, because the numbers is the easy part, but actually getting the motivation to keep them on track, keep them on the plan to get to their goal is mostly the emotional side of it.
Yeah, absolutely. And just for your listeners, CPD is continuing professional development point. Yeah, so it's about making sure that the professionals stay on the top of their game. Yeah. And you're absolutely right. It's a process that consumers need to have that confidence in the professionals that they're with. It's a complex area. That relationship side and moving all that together, as you said, it's sort of very hard for machines to come in and work that out because they haven't quite worked out all the different little bits. So, yeah, it's a crazy world when you consider how much has to go into it from the advisor's point of view. And people walk into advice office just don't quite really understand why it's so expensive to produce this advice and. Yeah, unfortunately, it is at the moment.
Yeah, and I think you said it right, that it will stay a people's business. And that's why I always think robo-advice won't replace a person-to-person relationship, especially in this area, but it can help at least try and make you more efficient for that advisor to provide that. Actually, basically, the back office gets all done that way, so it does give the person more front time to actually have the relationship with the client and help them through this. I probably wouldn't mind just one last comment from you on the fear factor, because you would have had this like I have, when a lot of people come in and just say, I've realized it's retirement, for example, is just around the corner. I've left it too late. I get that. I'm so worried I will never, ever have enough to retire and I'll have to keep on working forever. That fear factor sometimes is a motivator to get them in, but you're starting from such a long way back because they're just so worried when really doing the number side of it. But that must be something you realize you've got to help that client overcome.
Yeah, fear is something that affects all age groups and is not great in all age groups, because if you get somebody in their 20s and 30s, you're talking to the sandwich generation. If the kids come in and start off early. Don't have the fear of, this is going to be what sort of experience is going to be, and then sets them on a pathway. There is so much of a difference that you can make, obviously, because of the timing, and the length of time between, their age now and when they retire. There's a huge difference you can make. And then you're right about the fear. The fear is a motivation. The way I look at motivation is there's two directions of motivation. There is away from and towards. And fear sort of gets people often moving or it cripples them, right? There's the fight or flight. And so, when we talk about negatives or fears or worries, often that sort of gets people moving, but then you sort of need direction and positive affirmations as to where they're heading in the direction for motivation. So I see motivation as movement from a still position. And sometimes fear can give people then the initial nudge that they need to move in a direction. Other times it cripples them and they can't move. So it's a really horrible thing when it comes to money, because the best thing that any generation or any age group can do is to confront that fear and then move past it and then do something and talk to somebody. Even the more talking about it we can do, the better. And the more talking, it used to be a taboo subject. Growing up, I'm sure when you were growing up, you didn't talk about, how much money people made or all those sorts of things. It was a very private and hidden piece of. But the more we can be open and honest, and even with our friends and family around money and feels and feelings, that the better we can be and the faster we can move on. And obviously, talking to a financial advisor is a safe space to have that conversation in. But certainly, the more you can embrace the concept of, I'm going to go talk to this professional about it, and I'm going to be able to spill all of my past wins and all of my past mistakes with them for them to be able to point me in the right direction. At the end of the day, they're not going to judge me for all of the mistakes I've made. No way. They're just there to help me get to, as quickly as I can, or as best as I can, to the goals I want to achieve.
Yeah, no, it's a safe place. And I also find that usually once people actually talk about it, it's not usually as bad as what it is, what they're thinking. And so all those keep you up night moments and all that, once they actually talk about it, you even put it down on writing. And I often say to people, okay, even if they're in their 50s and 60s, well, it's not as if it's a finite line because you turn 65. Hopefully you're planning to be here for the next 20, 30 years. So you've still got time to get your money invested better, to look at what you're doing. And so, yeah, it's very rarely, I'm going to have to work forever. It's very rarely that situation. But Fraser, it's been great to... please.
Actually, can I just throw a comment in on that? Just on that, it doesn't matter what age you are now. There's always going to be next year and the year after and the year after, the year after, right? Sure. So the choice is either you do or you don't, right? Yeah. Because if you let's say you're 60 or you're 55 now and you got 10 years before you think you might retire, you're still going to retire in 10 years, right? So if you do nothing, you're going to get what you get now. If there's a possibility you could be a lot better off, then it's good. So it's not about saying, I've missed the boat or I can't do anything now. I mean, that's an argument that sort of can be easily thrown out by saying, well, there's no point worrying about the past. You could have changed stuff in the past. Then you can't change that now. So we can't worry about that. All we've got to do is the best from this point on.
Yeah, no, agree. One thing I like to ask all our guests is the best piece of advice they've ever received. And I think it's a nice place to finish on, and just as something that you've been told over the years that doesn't have to be financial, but you've just that's stuck with you.
Probably so many. I mean, at the end of the day, I think I've always remembered something that my grandmother told me, and that's talking about, I think we were probably doing shop or playing Monopoly or something at the time, but she always used to say, it's not what you make, it's what you keep that counts. And so it's never about, and you always see people with, there's always somebody with a high salary that blows it all, and so it's exactly right. It's about making sure that each week or month or payment cycle, then it's about working out what you can keep. And on top of that, some of the best advice I've ever learned around that was paying yourself first. And that is, taking the concept of, if I'm if I'm the most important person in my life, then I should be paying me first and putting the money into my investments first and then spending the rest rather than trying to work out if there's anything left after you spend.
Yeah, no, totally agree with that. Fraser, it's been great to have you on the show, and hopefully we can talk again soon.
Thanks for getting me on, Mark, and I hope all the listeners got something out of it.
Thanks. I hope you enjoyed this episode. If you'd like to know more about Fraser Jack and listen to his own podcast, visit xyadvisor.com/podcasts or search XY Advisors on your platform of choice. Also, feel free to either email me on admin@themoneysandwich.com or visit our website, themoneysandwich.com, if you have any questions or want to learn more. Enjoyed this episode and want to hear more of A Bite from the Money Sandwich? Make sure you subscribe on your platform of choice so you can automatically receive each episode as soon as it's released. As with every podcast, this information is not advice, as not personalised to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.